Good morning to you. And the last topic of this course, managerial accounting, we shall be studying. It's financial ratio analysis and EVA. EVA stands for economic value added. I know some of you who started this diploma program in 22, but in spring, they have done this topic before. So therefore, I'm not going to make it very elaborated topic. I'm just going to make it very basic level. So for those people who joined this program in spring 22, they would be having some advantage because they have done this topic in a way before. In fact, they have done more comprehensive version of this topic than what I shall discuss with you today. But it's not a very complicated, so I think it shouldn't be a problem. You know it or you don't know it beforehand, it doesn't make much difference. Financial ratio analysis is basically a subset of fundamental analysis. Whenever we have the financial analysis, it can be split between two types of subcategories. The one is the fundamental analysis. And the fundamental analysis is based on the fact that history repeats itself. History have an impact on our position or situation that we have today. So therefore, if you want to analyze what you have today, you cannot decouple yourself from the history. And then based on the history, you know your position today, and today you are making decisions for tomorrow. So when the tomorrow comes, today would become the history again. So this ghost of history never goes away. It stays with us always. So the fundamental analysis is based on the assumption that the history, the past, the analysis of past today makes us capable of making decisions which are much better, which can be much useful for tomorrow. So there is a chain link between the timings that the today is impacted by the past and tomorrow would be impacted by today. So this is the whole idea of fundamental analysis, which is also called historic analysis because we believe too much in the history. The second set of analysis is called technical analysis. Technical analysis say that we don't care about the history. The events come and go randomly. The randomness. What was random in the 13th century cannot be random in 21st century. So the dynamics change, the environment change, surroundings change, people's perceptions, mindset, way of thinking, it changed. So how come we get stuck to the history all the time? Technical analysis, they don't believe that history has some role to play. But those who believe in the fundamental analysis, they do believe. In all the financial houses where they do this data analysis, there are two types of group of analysts. One are the fundamental analysts, and the second are the technical analysts. So based on the kind, because every company, every investment house, every pension fund, every mutual fund, every investment company, they always want to have both fundamental and technical analysis. Essentially, the fundamental analysis is meant to do some diagnostic test. So in many ways, the word diagnostic is carefully chosen from the medical sciences. Just before we want to have some health check, if we want to make a decision that this person is hale and hearty, good health, no diseases, no any danger looming, we always send the patient or the person to some diagnostic test. Okay, let's have the blood pressure, measures. Let's have some blood count, this, that, all, there's a whole series of tests. So they are called diagnostic tests. And then based on that, your GP would make a tick that, okay, this is fine, here you need to be careful, this is a little bit dangerous, not too dangerous, a little bit dangerous, borderline dangerous. So do this thing, don't eat this much, don't eat too much of salt, blah, blah, blah. So that way, that is called health diagnostic tests. Same way, if you want to have a check of the company's financial health, we also do the financial diagnostic test. We check the company's liquidity, solvency, profitability, operations, profitability, and I mean these kind of different types of categories of tests we do. Like, for example, in medical sciences, we have some diagnostic test about your brain functioning, heart functioning, other vital, the organs functioning, and so on and so forth. Same way, in the fundamental analysis, we apply some, some health checks, financial health checks. And based on that, we make a decision if the person is fully fit, no problem, or if there are some care to be taken, or if there are some issues, then we need to find the next stage is, after doing the diagnostic test, is to do the treatment. Same way, we also do the financial treatment as well, which you will learn slowly. But at the moment, you need to know only the diagnostic test. And all the data of the diagnostic test, they come from our financial statements, 3 statements majorly, the income statement, balance sheet, and the cash flow statement. The first diagnostic test, or the first financial ratio, is called profitability ratio. The profitability ratio basically checks that the shareholders, they are the key risk takers of your company. They have invested the equity. And then with that equity, you are going to use this money for the company's operations. Are you generating enough profit from the company's operations that the shareholders are satisfied with you? The first diagnostic test is that, are your shareholders happy with you? Well, very simple. You can find out the operating return on equity, which is equal to operating profit, and it's divided by the shareholders' book value of equity. And as you know, I think I told many times that finance is not like a chemistry, that where sulfuric acid is always H2SO4, water is always H2O. No, this is a social science, technically. It has many, synonyms, many the words which are interchangeable. Therefore, different books, different researchers, different scholars, they use the different word for different, phrases. So for instance, the operating profit, you can see I wrote a footnote, number 1. It also can be called as EBIT, earnings before interest and tax. It can also be called as operating income, or operating profit, or net operating profit. Sometimes it's even called the income before interest and tax. So even not only EBIT, but sometimes even IBIT. Basically, operating profit shows the company's profitability, which is directly coming from the company's main operations. Okay, so for example, if Yumk's operating profit you want to check, they should come mainly from the Yumk's main services, which is education, training, consultancy. But for example, if Yumk is getting some interest on its deposits, or Yumk has invested its money in Finnair, that is not the operating profit of Yumk. That is a profit, definitely. If it is a profit, then it is a profit, but it's not called the operating profit, because The main job of YUMP is not to keep the money in the bank deposits. So therefore, operating profit is that profit which come from the main activities of the company. So that is why we don't take here net profit or gross profit or this profit or that profit. We only focus on the operating profit. And how do you get it? You have the operating revenue, which is equal to the amount of sales you do, less any return. You minus cost of goods sold. The cost of goods sold includes the cost of production plus the cost which you incur to make the goods ready for the consumption from the factory to the retail store and so on and so forth. And then you subtract some other operating expenses, and also you take away the depreciation and amortization. Depreciation we discussed a few times. That depreciation is basically the loss, the falling value of the fixed assets because of the wear and tear. Depreciation is on the fixed assets. Like for example, if you buy a car, and you know that the car would last for 20 years, that's a working life of the car, then you can split the whole value of the car into 20 parts. And you can say that, okay, every year you bought a car for 50,000 euros and its average life is, let's say, 25 years, let's count it. So in other words, every year, 2,000 value from the book value, you keep reducing. That's called depreciation. So that by the end of 25th year, the book value of the car is zero, okay? Amortization is on the intangible assets. So the only difference between depreciation and amortization is that depreciation is on the fixed asset. It's a fall in the value of the fixed assets, whereas amortization is the fall in the value of the intangible assets or the intellectual property, and likewise. The denominator is shareholders' book value of equity. So the shareholders' book value of equity is also called net worth or net assets, and that is equal to the total assets minus total liabilities. And that shows the shareholders' equity, basically. So this is a very pure measure that the company's profits, but not just any profit, but the company's operating profit divided by the book value, the shareholders, the book value of equity. And if this profitability is growing over time, now again, the problem is that if this ratio comes to be 12%, you cannot make out if this 12% is high or low. You have to compare with the time and space. With the time is that you are comparing your own company's performance with the previous years. So let's say this year you have 12%, last year you had 9%, previous years it was 7%. So you can see the growth, 7%, 9%, 12%. This is when you are comparing yourself over a time period. You can also have a comparison over space, or we also call it cross-section comparison, where in the same year, you compare yourself, you compare your performance with some of your competitors. So for example, if there are 5 companies in the competition, in the business where you are in, then in the same year, you compare operating return on equity performance with the other 5 competitors, okay? And then you can find out that where in the league you stand. Are you number 1, number 2, number 3, well, for the same year? Or you can do both. You can do both, a comparison both over time and space. There's no magic number, there's no yardstick, there's no legend that if this ratio is this much to this much, it's good, if that much, it's bad, whatever. So therefore, it's very important that you make sure that you are making a right kind of comparison. The second ratio that we have is called return on capital employed. The return on capital employed is a little bit a more comprehensive measure than the return on equity, because in the return on capital employed, we include both type of capital. And we know that capital is basically companies financing, where the money comes from. And the money comes from debt and equity. In the first formula, you only had the denominator, the book value of equity. But equity is not the only form of financing. We know that debt is also an important form of financing. So therefore, nothing much changes here. The only thing is that the denominator is replaced by total capital employed, which includes the debt as well. And debt, we mean the long-term debt. We don't include the short-term debt because that is for the, that is more for the operating purpose, like day-to-day operations. Because with the short-term debt, you can't make a big investment, but with the long-term debt, yes, you can. So therefore, the only thing is that in the total capital employed, we include the equity, plus we also include the long-term debt, which if you, I know you have seen some of the annual reports of the companies, and over there, even though in theory, long-term is a good expression, but usually we use the word non-current, debt is the word we use, financial debt, basically. And again, the interpretation is same. Higher the return on capital employed, better it is. We prefer more and more. The second diagnostic test that we have is called liquidity ratio. Liquidity ratio means that how liquid are you, how well you can pay off your day-to-day expenses. Liquidity is a very important thing, because if you can be a multi-million-dollar company, but if you don't have money to pay for your salaries of your staff, you don't have money to pay for the rent or taxes, it can bring a lot of reputational loss to the company. So therefore, liquidity is, by definition, liquidity means your immediate paying capacity. Okay. Many times you see that people are having lots of money, palaces, but they don't have enough money to even repair the palace, because there's no routine, there's no regular source of earning which can be used to repair those expensive $1 million worth possessions. So liquidity is your current revenue and expenses, and your current assets, current liabilities. So that is all about the liquidity. The idea of liquidity is that if you are less liquid or illiquid company, then you cannot meet your short-term obligations. And if you cannot meet your short-term obligations, it will not take a long time before you can't even make your long-term obligations. And then the problem of insolvency can arise. So we have an adage, we have a saying that nip the evil in the bud. So the idea is that if you want to avoid any long-term payment problem, make sure that you don't have any short-term payment problem. So short-term payment problem can arise if the company is not so much liquid. If the company's current income is not enough to meet its current liabilities, then it can be a problem. The formula is very simple. The first ratio is called current ratio. And the formula is the total current assets divided by total current liabilities. We know that where we get the current assets and where we get the current liability, they come from the balance sheet. This formula has slightly a little bit of a legend. And the legend is that we prefer 2:1 ratio. That if your ratio must not fall below 2:1. It means that at any point of time, your current assets should be double than your current liabilities. I don't know. I have some problem with this kind of legend because depend upon company to company. Some companies are more cash based, like retail store. So obviously they would be having more current assets for the given current liabilities. But then there are some companies, like the oil companies, they're not dealing strictly in cash to their B2B type of transactions. So therefore, they might be having different current ratio. I believe that as long as you are showing a growth over a time, or against some benchmark, or against some immediate competitors, and there is a growth over time, or at least there is stability over time, it should not. It's a good sign. It's a good sign, yeah. But still, some people believe in these kind of legends like 2:1, 3:1, whatever. But I personally have a problem with this. The reason I'm discussing it with you, I could have simply deleted this sentence because this 2:1 is mentioned in many textbooks. So that's why I'm making you aware that some people believe in these kind of benchmarks. So you can see that, for example, depending upon the nature, right? I think it's if you are performing consistently over time, so it's not a big deal, even though it's less than 2. I mean, of course, it shouldn't go down less than 1. Then it means that your immediate payment pressure liabilities are more than what you own. Then it can be a big problem. So try to stay away from 1. Try to be as high as possible than 1. It's a good sign, yeah? Then we also have the second ratio called acid test ratio, or a quick ratio. The quick ratio or the acid test ratio, there is a problem with the current assets. By definition, the current assets are those assets which can be converted to cash or cash equivalents without wasting too much of time and without wasting too much of resources. I can give you an example. Let's say you have a house which is multi-million euros, okay, and you want to make a payment to somebody, and you want cash right now, and you don't have cash. Then what can you do? Well, the one very old way of doing things is that sell the house. But house is not something you can sell in 5 minutes. Selling a house, finding a customer, it can take even years. So it means that the house, even though is an asset, but it's a very illiquid asset, less liquid asset. But not all the current assets, even the current assets are not so liquid, not all of them. For example, one of the current asset is called inventory, the raw material, semi-processed goods, finished goods, but not fully, finalized. If you want to have cash, it's very difficult to convert them to cash because who will buy your raw material? Who will buy your semi-processed goods? Very difficult to sell them. So therefore, the acid test ratio is a little bit more practical, and it says that not all the current assets are equally liquid. Therefore, let's take away the less liquid assets from the current assets, and let's call them as quick assets. So what they do is that they don't consider all the current assets, but they minus inventories, because you can't, if you are in a need of cash, what would you do if you have only inventory? Let's say you're making furniture and you have half-finished table, the wood stock is there, and you need cash. how would you sell it? Why would somebody buy from you? So you have to approach certain very specific customer who will buy your inventory. So therefore, inventory is not so liquid, even though inventory is a current asset. Okay, so that's very important distinction, that not all the current assets are liquid. By liquidity means that the speed and the convenient of conversion of the asset to cash is very convenient, very comfortable. For example, I have shares of Nokia, and I'm in a rush of money. I'm needing money. I can sell my stocks. It doesn't take me a long time, a few minutes, and I can sell my stocks. I have some bills collected from my customers, and I need money. I can transfer my bills to the bank, and the bank will make me payment instantly, no problem. Okay, so therefore, the current, the convenience in terms of the speed and less loss of value, that makes an asset liquid or less liquid. And then the third ratio is called cash ratio, which means that we don't deal with any other asset. We only talk about the cash, which means the cash divided by the current liabilities. Well, different measures can be applied in different circumstances. So, and then the third category, we have the solvency ratios. The solvency ratios basically mean that solvency ratio is very much connected with the liquidity ratio. Liquidity means, are you able to make payment in the short period? Do you have the current assets more than the current liabilities in the short period? Solvency ratio means, are you able to make the payments in the long term? And here we go beyond current assets and we take all type of assets and we take all type of liabilities. So a company is called solvent if its total assets, not current, not non-current alone, if its total assets are more than total liabilities. If your total assets are more than total liabilities, then this figure is positive. It means that the shareholders' worth is positive. On the other hand, if your total liabilities are more and the total assets are less, then this middle figure, the shareholders' worth, would be negative. It means that the shareholders have lost their value and the company can be declared insolvent. Okay, so this is about the long-term payment issues. So that is why I said that if you want to avoid any long-term solvency problem, make sure that you don't have any. If you want to solve any long-term solvency problem, make sure that you don't have any short-term liquidity problem. So therefore, cash management is very important. Cash management is done by the corporate treasurers. This is why the role of treasurer in the finance department is very important. The first ratio is very simple. You have total assets.
Abhijit here. I have one question.
Okay, so the second ratio is the debt to equity ratio. How much debt we have for the equity. Once again, there is no such legend, but as a rule, we believe that if debt is constantly rising, it can be a problem for the company. It can push the company towards bankruptcy. Both debt and equity, and by the way, there's no magic number where we can say that this is the best debt to equity ratio. Debt has some advantage. Well, debt is cheaper because debt, we have discussed many times, the debt is nearly tax-free because the interest is paid before the tax is paid. So therefore, tax burden doesn't fall on the debt payments. That's a good thing. Another good thing of debt is that it keeps the managers always on surveillance. It always keeps them on toes, because on debt, you have to pay the interest and also have to return the part of the installment, the total debt you have to pay. So there is a more pressure of financial performance on the managers. So it keeps them agile and alert. Whereas in equity, there is no such pressure. So the managers can become lazy and they can become complacent. So therefore, debt has some good things, but the debt has the bad things also. The bad thing is that it can push the company towards bankruptcy, because if there is a pressure of financial performance and you're meeting it, great. But if there is a bad external environment and you are not able to meet your payment targets, then the company can run into crisis. It's like panicking. You start panicking then. And when you are panicking, you very often take suboptimal decisions. Obviously, when you are borrowing, some debt covenants have to be followed. Debt covenants means that if you have to comply with the conditions of the lender. Okay, so whenever you get the debt, whenever you sign the debt, like for example, many of you at some stage will start thinking of buying houses in the country. Obviously, you will approach the banks. The banks will give you loan, but there'll be a loan agreement which says you can do this thing, you can do this thing, but you can't do this thing. Okay, so you have to follow the debt covenants. Okay, debt includes current and non-current financial debt, but I think that the purest form of the debt is the non-current financial debt. Sorry, there's a spelling mistake here. So it's the, yeah. So I think the real debt, who we call as a debt, is this one, non-current financial debt. This is the real debt. The current debt is still a debt, but it's more from the operational point of view, not from the investment point of view. If you want to make a big investment in the company, you cannot do it based on the current debt, because the current debt can mature anytime before 1 year. Okay, whereas a non-current financial debt can go for maybe 5 years, 10 years, 20 years. If you buy a house mortgage, for example, in many countries, it can go even 20 years, 30 years. Another health check that we do is called investment ratio. And we have two ratios here. The earnings per share. The earnings per share is how much earning is available to the investors and how much earning is available per share. So you can see here that your last measure of profitability, if you ever happen to see the company's income statement, I'm sure you will, because you will be doing the assignments based on it. You will find that the last measure of the profitability is the net profit, which is after paying everything, like tax is paid, everything is paid. The final profit is called net profit. But from here, you also subtract the preferred dividend. Preferred dividend, why we subtract? Because preferred dividend goes to those shareholders which have the preferred stocks. And what is preferred stock? The preferred stock is a hybrid share. It's in between the debt and equity. Investors are preferred in when giving the dividend to them, but in turn, these shareholders don't have the voting rights. So those who own the preferred shares, they are preferred when the company gives them dividend. But in turn, they have to surrender the rights to vote. So they are called, they are called the shareholders with no. All good? So they are called shareholders with no voting rights. And this is why the preferred shareholders are also called non-controlling shareholders. Non-controlling means they don't have a control over the company because they can't vote. Why can't they vote? Because they exchange their voting rights with their right to get the dividend first or before the other shareholders could get the dividend. And what is the name of the other shareholders? We call them ordinary shareholders. Okay, so sorry, the ordinary shareholders are the very pure form of shareholders. Yeah, and the second measure is the price to earning ratio. So price to earning ratio, and here E, you can see P/E. E is exactly the EPS in number 1. So E and EPS are same thing, the price to earning ratio. If your company's share price is increasing for the given E, it shows that your company is performing good in the stock market, okay, which is a good sign. So if your company's stock prices are going up in the stock market for the given earnings per share, which you are offering to the investors, it shows that people trust you, people believe you. All right. So these are some of these health checks which we do. Broadly, these are 4: profitability, liquidity, solvency, and the last one is called investment ratio. So these 4 health checks are part of the fundamental analysis, and the investors do them to make a diagnostic test, financial diagnostic test of the company, and then make a decision to stay with the company or not to stay with the company or whatever they decide for the future. Okay, so in 2 minutes, have a quick look at these slides up to number 10. If you have a question, please ask me. Otherwise, I will move to this very interesting topic called EVA. So I give you 2 minutes. Any questions, you can ask me. Okay, the last topic for this syllabus of this course is economic value added. Today, I shall discuss the theory part only, and I will let you experiment with the numbers by yourself. And because we will be meeting next week as well. And next week, when we meet, I will give you an opportunity to ask me questions if you want to discuss your problems, numerical, theoretical, whatever. So if you play with the numbers, you do some calculations, and if you struggle, you can ask me next week, or you can do it in front of me next week. But there's nothing which you haven't done, basically. So this EVA will be having a formula, and the formula will be containing some components, and none of the components you are unaware of, I can assure you. So basically, all the data will be coming from your income statement and balance sheet. Something, please correct me if I'm wrong, or if I'm. We have discussed CAPM somehow in the class.
Yes, we have done it.
Okay, great. So capital asset pricing model is the only formula which you need to do, which you require to do economic value added, which is not coming straight away from the income statement or the balance sheet. Otherwise, all the data will be coming from there. Okay, so economic value added is a concept which shows the conflict between the economist and the accountants. A very big part of my life, I have been an economist. I didn't move from economics to finance suddenly. My first master's was in economics and the second was in finance. But even after completing my second master's in finance, I still used to think like an economist. It took me some time to go deep into the finance waters and stay away from economics, but still there is a pull and pressure between heart and mind, whether I'm an economist or a finance person. There is about the performance of the company. Accountants and economists, they differ. Accountants say that the profit is residual. So basically the company earns revenue and subtract all costs, and whatever is left, or if there is anything left, it goes to the shareholders. It can be a lot of money, it can be even losses, whatever. But one thing, if you notice ever, I wish that you see this thing today, all of you. Just open the income statement of any company and check out that there is a provision for finance cost, which basically is the debt cost. But there's no provision for the cost for the shareholders. There's no shareholders cost. In other words, we assume that whatever is left goes to shareholders. This is the accountant's way of thinking, that the profit, the profit which companies get is the residual profit, leftover, and all the leftover goes to shareholders. It means that we believe, we accept the claim of the shareholders, but we do not accept the cost of investment, the equity investment. Whereas we do recognize the cost of debt, but we do not recognize the cost of equity. We make the shareholders entitled for the leftover, but we do not calculate the cost of equity investment. And this is what the economists challenge. They challenge that how can you entitle somebody whose cost is not even calculated? So they believe, the economists challenging accountants, that, hey guys, if you want that there should be a calculation, just like you have the cost of debt, just like you have a cost of financial debt, also have the cost of financial equity and subtract it, and then show your real profits. And this is exactly I don't know whether you are aware or not, but the countries, like the companies calculate their profitability, the countries calculate the GDP, the gross domestic product. And this is exactly the way the GDP of the country is calculated, that there is no straightaway claim given to one stakeholder that, hey, this is the leftover, it belongs to you. No, all the costs are calculated. Whenever you are calculating the net value, added in the country, you are subtracting all the costs. Whereas when we are calculating the cost of financing, we only include the cost of debt financing. We do not include the cost of equity financing. So therefore, the profits which the companies are reporting, they are inflated profits. I will not be satisfied with myself. I want to give you one example, and then you can see it by yourself. So if I have, for example, Finnair annual report, we can quickly have a look, because then you can see that what I'm talking about. Here you can see there is a financial expense, but this financial expense basically only includes the debt expenses. It doesn't include the equity expenses. And then whatever profit is left, results for the period, this is negative, so there is a loss. So this loss is to the shareholders. But the EVA says that, like when you calculate the financial expenses, calculate the cost of debt and also calculate the cost of equity here, the minimum cost of equity here. And if you start doing it, and then you have the final income, that you can say that, okay, this is now, again, this is the residual claim of the shareholders. But before you give the right of residual claim to the shareholder, you also calculate their cost. Now, in this case, situation is very interesting because the shareholders are already having losses. 523 some a million euros are lost. So there is almost €500 million euro loss to the investors. Which investor? The shareholders. But if the cost of equity, which you will learn to calculate today, if that would have been added here, this loss would have been even more. And that would have been the reality according to the economists. So even though Finnair is having loss, and this loss is calculated by the way accountants think. This loss is calculated the way accountants think. But if you calculate the Finnair's performance as the economists calculate the GDP of the country, then this financial expenses would have also included the cost of equity. And then this final loss would have been more than the loss that we have today. So technically, the economists are accusing accountants that, hey, you guys, you're hiding the true loss. You are hiding something. And this is the whole idea of accounting data, that you want to be truthful, you want to show the fair treatment, the fairness about the company, the true health of the company, disclosures, transparency. And the economists here have a role or have a reason to accuse accountants that you are calculating the company's performance and you are not including the cost of equity as if the equity is free of cost. Equity is as expensive or rather more expensive than the debt. So how on earth you are able to ignore this such a vital fact? Whereas the accountants think that no, the company's profitability, the company's profit or loss is the residual claim of the shareholders. So they have the final say. Economists challenge them. They say that, okay, if you're a small company, a private company, it's still okay, acceptable. In the public limited companies, when you have millions of shareholders and there are hundreds of millions of shares, and the company is not trading in one stock exchange, but in the multiple stock exchanges, they are having very complex operations, then it's almost, it's almost laughable to assume that the equity is a free gift of nature. It's free of cost. So therefore, there is an inherent conflict between the accountants and the economist. And in EVA, through EVA, economists are accusing accountants for hiding a very important fact and overstating or overinflating the company's performance. Finnair is doing bad, for sure, but this performance would have been even worse if the equity expense would have been included into it. But the fact is that in this amount, the equity expense is not included. It's only debt expense. It means that the companies are ignoring their equity expenses. And the reason they are ignoring is this philosophy called what we call as a residual claim. Okay, so this is the debate. This is the philosophical debate between the accountants and the economists. And the way it is calculated, it's quite simple. The EVA is calculated as net operating profit after tax. We call it NOPAT. Okay, you know what is operating profit? We have discussed so many times now. Net is, it doesn't make any difference because mostly the operating profit is net because it is calculated after depreciation and amortization. So basically you have your operating profit after tax, and then you are minusing, you are subtracting the capital charges. And the capital charge is total capital employed, which includes long-term debt plus equity. And this you multiply by weighted average cost of capital. And I think the weighted average cost of capital also we have done in the past. Okay. And the weighted average cost of capital we did when we were calculating the debt tax shield, or I think that when we were calculating this CAPM thing. So the company's weight of equity. So you can check what weight of equity and what weight of debt the company has. So for example, if you look at the Finnair's balance sheet, you can check that the company's equity is 896.6, and the company's total debt is basically, where are the financial debts of the company? Just a sec. Non-current liabilities, lease, yes, financial lease. This, so 880, 110, 1.5 provision, no. So if I add 88, wait a sec. So if I add 880, 11, 10, okay, 1 is not a big deal. And 199, and how much is the equity? Equity is 896. So if I divide 191, so if I have 1991 as total debt and equity is 886, then the total value of the company's in terms of finance is 7,718,2. So I can say that the weight of debt is 1991 divided by 2877, and the weight of equity would be 886 divided by 2877. If you want, I can do this calculation very quickly here. So when I see the Finnair's debt, it comes out with the long-term debt is 1991. And when I see the company's equity, it's 886. And then the book value of the company's finance is equal to 2877. 2877. And then the weight of debt, the percentage of debt is equal to 1991 divided by 2877. And similarly, the weight of equity which company has is equal to 886 divided by 2877. So I can, well, you can calculate exactly what it is, but I can quickly calculate that it's nearly 30%. So debt is nearly 70%, and the equity is nearly 30%. Okay. Yeah, and if you calculate D to E ratio of Finnair, which is a very important diagnostic test of solvency, you have seen in the previous section, 70 divided by 30, it will be 2.33. It's quite a lot, actually. You know, it means that for every €1 of equity, you have €2.33 of debt, which is a big amount of money, I would say. Yeah. But as I said, that you do this exercise by yourself. I don't want to do everything on my own because it's your assignment. Try at home, and if you struggle, then ask me next week. All right. Yeah. Can you see the slides? Is it visible? Well, let me share it again.
Yes, sure.
Yes, yes.
It's visible. We can see that.
So this way, you can calculate the weight of debt and weight of equity. TC is called the marginal tax rate. The marginal tax rate, I think we discussed a few times before that it's not the headline tax rate. It is the tax which company pays, exactly the percentage which the company pays the tax, and it is equal to tax paid divided by a profit before tax. So I think in case of FinAir, it will be negative because they have a loss. But in the normal businesses, when you have a, let's say, I can do the calculation. If you have a, hypothetically, if the profit before tax is 100 and the company pays tax 30 euros and the profit after tax is 70, then the marginal tax rate, or we call it effective tax rate, is equal to the tax you pay divided by the profit before tax, so which is 100. So you can say that the effective tax rate of the company is 30%. This is what we take. And then we have, what else we have? Well, we have the cost of debt. And we have the cost of equity. The cost of equity, RE, is calculated by capital asset pricing model. And I hope that you guys are aware of what is capital asset pricing model. We discussed in detail in the valuation chapter that where this beta come from, the market return, and how we find out. And I think that also I did in case of FinAir case, that how you would know that what should be the minimum return which should be expected on the company. So capital asset pricing model will give you return on equity, and the expected debt return. Where does it come from? Well, it comes from very easy way. Once again, I have to show you so now we know that the company's debt is 1991. The question is, where is company's interest payments? Where is the company's finance cost? So we need to go back to the income statement. Well, the company's is finance expenses 255.2. 255.2. So remember now that the finance expense is 255.2, and this only include the debt cost. Debt cost is 255.2. Let it be 255, and this we get from the income statement. And I just showed you before that the company's total debt is 1991. So I repeat this figure here. So total debt is 1991. So basically it means that you have borrowed 1991, and you're paying 255 as the debt servicing. Therefore, the cost of debt in percentage would be 255 divided by 1991. I think it'll be quite a lot. Yeah. So the debt is quite expensive. It's about 20% something plus, which is weird. So this is how we calculate the cost of debt. Okay, and then we put all these numbers and we calculate the weighted average cost of capital, And then we have, well, once we have the weighted average cost of capital, we multiplied the total capital employed, and total capital employed, it's long-term debt plus equity. And that would give us the capital charges. And this capital charges must be subtracted from net operating profit after tax. And that would give you the true performance of the company. So many companies whose profits look very beautiful, very shiny, they will go down. And many companies which have the losses, their losses would go even more by including this reality. So the idea is that I'm not saying that this side is good or that side is good. They all have their own way of thinking, the way of philosophy. I mean, they have their own, way of. I can't say which one is right or wrong, but EVA is a classic example of the conflict between the economists and the accountants. So it's an outcome of philosophical debate in which the economists are saying that, hey, you accountants you are not even counting the cost of equity in the company. So how can you assure that there is transparency and there's a truthfulness? Okay, so this is all about EVA. But as I said before, that in our next meeting, I would give you an opportunity to practice things in front of me, and we will be meeting next week. So there's nothing more from my end. I can stay back for some time. So if you have any questions, you can ask me. Thank you so much.